Jamila, I will be doing grade 10 accounting June 2024. Question one is about concepts and analysis of transactions, and it is worth 45 marks and needs to take us at least 35 minutes, actually at most. Now for 1.1 concepts, match the principle in column A with the example that best describes it in column B. Write only the letter A to E next to the question number. So we have 1.1.1 to 1.1.4 in your answer book. So we have column A, which gives you a concept, and column B gives you the definition. Let's start with the first one. It says a fixed deposit. Please note that a fixed deposit is money that you put into a special account for a specified period so that it earns interest. All right. So it's basically an investment. You put money for rainy days, and sometimes it's not just for rainy days, it's just to generate interest or some sort of income from it. Now, A says small cash amounts kept in a lockable money box for making small payments. We know that's a petty cash. So we already know that for 1.1.3, it'll be A. And a facility granted by the bank to borrow funds. The funds borrowed are owed to the bank. That will be a bank overdraft, which allows you to take more money from your bank account. And we've got C, which says that money that is invested with a financial institution for a certain period of time. And you can tell that is actually 1.1, which is a fixed deposit. So for 1.1.1, your answer will be C. 1.1.2, well, I read up to C. D says cash kept in the cash register. That is a cash float. And we don't have any concept here relating to cash float. So that will be cash float. E, measures put in place to ensure the smooth running of the business. Definitely that is 1.1.2. So 1.1.2, we can safely say that will be E. Petty cash, we said that will be A. Bank overdraft, we said that will be B. And obviously we'll get 1 mark per answer that you give here. That is it. 1.2 requires to prepare the analysis of transaction, i.e., the accounting equation. And we need to analyze the following transaction according to the headings provided in the answer book. The business uses a markup of 75% on cost. So you will have to highlight that 75% on cost. So that is the markup that we're simply using. Assume that the bank balance is favorable for all transactions. I'm still looking for an accounting equation that will say that the bank balance is unfavorable. So that one I will you just know that if money comes in, it will increase on the debit side. It will increase your bank account on the debit side. That is them telling you that the bank balance is favorable. If it was unfavorable, it will affect your liability. So every time money comes into your bank account, it will reduce your liability. Every time money goes out of your bank account, it will increase your liability because it will have been a bank overdraft. A bank overdraft, please note it is a current liability. Just like any other liability, it carries the same characteristics. It increases on the credit side. Now let's look at the example they're giving us here. They are saying that we paid 10,000 by EFT to Croxley suppliers for stock purchased. For that one, bank will be affected, trading stock will also be affected. Both of those are your assets, and that'll affect A in your accounting equation. That transaction will be recorded in the cash payments journal as they indicated here. You will increase trading stock because you bought trading stock. You will decrease bank because money is going out of your bank account. Both of them are assets. That is why under assets you have plus minus. Owns equity will not be affected and liability will also not be affected. 1.2.1, these are just transactions. We sold goods on credit. Highlight sold goods on credit. They gave us the cost price of these goods, which will be 700 Rand. Ladies and gentlemen, please go to the playlist and look for a playlist written in the general journal. I've done this a lot of times. I'm not going to go back to the slide that I normally show you. It's a very colorful slide with arrows, red and green, where I explain what happens when you sell goods on credit. Whenever you sell goods, whether for cash or on credit, four accounts will be affected, okay? You will increase bank if it was sold for cash, or you will increase debtors control if it was sold on credit. In this scenario, they were sold on credit, so will debit debtors control. However, you credit sales. Sales is income. Sales increases on the credit side at selling price whenever we sell. The other two accounts that will be affected will be cost of sales and inventory. Cost of sales always increases whenever we sell at cost price, and inventory will always decrease when goods are sold. Guys, it makes sense. We have less stock because we have given it to customers. They gave us money for that. We earned income, which is sales. Sales increases on the credit side. That is the income that you're earning. You're earning the selling price of the goods. You got that. However, there's a problem here. We are given the cost price, and sales and debtors control have to be recorded at selling price. However, we are given the markup percentage up there, which is 75%. You do know the formula, right? I'm going to start with the ledger accounts. First of all, that transaction, because it was a credit sale, it will affect your debtors journal. Debtors journal is a journal where we record all transactions or all credit sales, okay? All transactions relating to the sale of goods on credit. Basically credit sales. That's what it is. That transaction obviously be recorded in the DJ, which is your debtors journal. We sold goods on credit, so we debit debtors control, we credit sales. Debtors control is an asset. It increases on the debit side whenever we sell goods on credit. It represents people that owe us because they bought goods from us on credit. We credit sales because it's income. Income increases on the credit side. These two accounts must be recorded at selling price. However, we were given the cost price. So to calculate the selling price, you will simply take the cost price multiplied by 100 plus 75 divided it by 100. It'll give you 1,225, which is the selling price of these goods. So when you're given the cost price and you want to calculate the selling price, you will simply take the cost price multiplied by 100 plus markup divided by 100. If you're given the selling price and you want to calculate the cost price, you will take the selling price multiply it by 100 and divide it by 100 plus the markup. That is if you want to calculate the cost price. However, here you were given the cost price and you wanted to calculate the selling price. That's why we actually put that in reverse. Please note that 700 is at 100%. You multiply by what we want. We want the selling price, which will be at 175%. That is because you added a profit percentage of 75%, which will give you the selling price of 1,225. That will affect your asset. It will increase your asset, which is your debtor's control. It will also increase owner's equity. Owner's equity increases whenever income increases. Okay, owner's equity is increased by income and capital is decreased by drawings and expenses. Remember that. Here, liabilities are not affected. We're not owing anybody here. As the business, we are not owing anybody. Actually, as a matter of fact, we are being owed. And when we are owed, it affects our assets. Therefore, your liabilities will just be zero. That's it. Ladies and gentlemen. The other two accounts that will be affected will be cost of sales. As I mentioned, cost of sales increases on the debit side whenever we sell. Cost of sales, it is basically us expensing trading stock, which is your asset. So trading stock turns into an expense when we sell it. When we buy stock, it is trading stock, is an asset. When we sell, that stock becomes cost of sales. The reason why we recognize cost of sales whenever we recognize sales, we are trying to apply the matching principle, which requires income to be matched with expenses so that we report the correct profits. So that's why cost of sales is the reverse of sales. Cost of sales is an expense. If sales is income, cost of sales should be an expense. They'll never be on the same side. Whenever you recognize income, the corresponding cost to that will be cost of sales. We debit cost of sales whenever we sell. Write that down. Debit cost of sales whenever we sell is an expense. Expenses increase on the debit side. Trading stock is decreasing. We are de-recognizing it as an asset because we are selling it. We no longer have that anymore. Under assets, you will have, obviously, we were given the cost price, which was just 700. Okay. That's why I wrote it there that the cost price was actually that 700, but we had to calculate the selling price to get that 1,225. So that 700 is the cost price. So you're gonna write it here as 700 rand. Trading stock will be minus cost of sales is an expense. I just told you not long ago. Cost of sales is an expense. Expenses reduce owners' equity. They increase on the debit side, but they reduce owners' equity. We can say all the elements that fall under owner's equity that increase on the debit side, they reduce owner's equity. I call it SIDE, CIDE. Capital income, they increase owner's equity. Drawings and expenses, they reduce owner's equity. And the ones that reduce owner's equity increase on the debit side. I hope you got that. So under owner's equity, you only have four elements, guys. It's capital, income, drawings, and expenses. Just that drawings, when you go to grade 12, you call it differently. We call it dividends, but it's pretty much the same thing. Under owner's equity, we will have minus. And your liabilities are not affected. We're not owing anybody here. Be good. 8K, right? Clear as a day. Crystally clear. We've got 1.2.1 SQ Bank deposited 50,000 into the bank account as per the loan agreement. Note that here we actually took a loan from SQ Bank. So they deposited 50,000 rand into our bank account as per the loan agreement. The fact that they are depositing money into a bank account, obviously, as bank is affected. So bank is increasing. They are depositing money. Anything that has to do with money affects cash receipts, cash payment, petty cash. Which one is this one? Robot, right? It is the cash receipt because we are receiving money. Bank will increase on the debit side. But this is not our money. It's a loan. A loan is a liability. Bank increases on the debit side because it's an asset. Liabilities, though, increase on the credit side. A loan is a liability. We are owing SQ Bank. Please don't forget to write the name of the bank whenever a loan is affected. And the assets we will have plus because we're having more money, more shankura, more cheese. And owner's equity here is not affected. None of those two accounts fall under owner's equity. They're not capital income, drawings, or expenses. And your liability is going up. Whenever you credit a liability, it means it is going up. We are owing more. We owe in the bank, SQ Bank. They gave us a loan. I know someone is like, why don't we record it in the debtor's journal? Guys, debtor's journal is when we sell goods on credit. We are not selling goods on credit here. We were given a loan. Please remember this. Because when you get to do cash flow in grade 12, now people are wondering, why do we say proceeds from the loan? It's because we are getting a loan. We're getting money, mula, shankura, cheese. All right? So that's why we increase our bank account when money comes in. And people think that when you take a loan, because it's viewed as a wrong thing, they assume that cash receipts is not affected. Cash wise, it's good for the business. Okay? Because we're getting money, we're getting shankura. All right? I hope it makes sense now. Okay. Let's move on to 1.2.3. They already told us that we were the ones returning goods to the creditor, but well, I don't know what we were returning. Now, 1.2.3, a debit note. A debit note was issued for damaged goods. Guys, note that when we issue a debit note, it means we are returning goods. Because if goods were being returned to us, we wouldn't be issuing it. Instead, we would be receiving it. A debit note is issued by the person or entity returning the goods. These goods were worth 2,100. That was returned to the supplier, cementing it there that we're the ones returning it to the supplier by the name of Wiltons. I've seen that before. Wiltons. Croxley. Is it Croxley? Something like that. Anyway, because we are returning goods here, it'll affect creditors. And when we return goods, it will be recorded in creditors allowances journal. Note that creditors allowances journal doesn't work the same way as your debtors allowances journal. When a debtor returns goods, it affects 4 accounts. But here when we return, whatever we are returning, it will affect 2 accounts. We always debit creditors control. We credit whatever we returned, which is the cost price of whatever we returned. So it's quite easy, isn't it? Right? Here we return the stock. We will therefore debit creditors control. You don't debit creditors allowances. There's no account like that. It is not the same as debtors allowances, which is an expense. Please do check out videos on your general analysis of transactions where I explain that thoroughly. What did we return here? We returned trading stock. And because we returned trading stock, assets will be affected. Trading stock is an asset. And when you see an asset being credited, it simply means one thing, that assets are decreasing. Owner's equity is not affected here because creditors controlling trading stock don't fall under owner's equity. It's not capital income, drawings, or expenses. So we're going to have zero under owner's equity. And your liabilities here will decrease. When your creditor's control is debited, it means your liabilities are decreasing. Liabilities decrease on the credit side. Got it? Vanilla, right? Yeah, I know. Let's move on. Now, the owner paid 1,800 to Atlantis Club for his daughter's swimming lessons. Okay, that was going to affect bank. Obviously, bank is affected either way. If the owner was paying for something that was going to be used within the business, we're going to credit bank and debit whatever can be an expense or asset. However, here, the owner paid this to Atlantis Club for his daughter's swimming lessons. That is not even donations because the owner's daughter, whatever is paid to the owner's daughter, is the same as though it's paid to the owner. That is drawings and is taken for personal use. Daughter's swimming lesson, that is personal use. It has nothing to do with the business. Oh, it's Croxley suppliers. Oh, that's why we have Waltons thing. Anyway, what we're going to do here is to debit drawings whenever the owner takes anything from the business for personal use. We debit drawings. We credit whatever the owner took. Here, the owner took cash. I nearly said bank. The owner took cash from the bank. Therefore, we are going to credit bank. Be careful what type of cash the owner is taking. If the owner takes cash float, we credit cash float. If the owner takes petty cash, we credit petty cash. But here, the owner paid from our bank account, so it affects our bank account. This has to do with cash. Therefore, it will either affect our cash receipts, cash payment, or petty cash. It's not a small payment. Therefore, it will affect our cash payments because money is going out. Cash payments will always be affected when money goes out. We debit drawings when the owner takes any item, money or whatever for personal use. Because the owner took money from the bank, we are going to credit bank drawings. Affects which element? Does it affect assets, owner's equity, or liabilities? It affects assets, ne? No, it affects owner's equity. Remember, equity is affected by four things: side, capital, income, drawings, and expenses. Expenses and drawings, the last two, D and E, they reduce your owner's equity. Bank is affected. Bank is an asset. It's decreasing. It's credited. Therefore, asset will be minus. Owner's equity is reduced by drawings and expenses. This is drawings is debited. Therefore, it reduces owner's equity. And under liabilities, we have zero. You're getting it, right? We good. Not yet vanilla, right? Clear as 8K. All right. The owner paid 1,000. Okay, we have done that one. We will go to 1.2.5. A receipt was issued to D. June for the settlement of fees amount owing of 7,200. Please note that that 7,200 is the amount owing. It is not the amount that we received from D. June. An early settlement discount of 2.5% was granted to him. So we didn't receive 7,200. We received less than that. As a matter of fact, we received 97.5. How did I get that 97.5% of that 7,200? It's because that 7,200 is 100%. And DFL June will only pay a net amount after the discount of 2.5% has been deducted. To determine how much percentage we received from defulging, you will take 100% and minus that 2.5%. It'll give you 97.5 if I'm not mistaken. However, to make things as clear as 8K or 4K, what we're going to do is to record the transactions that are affected. We received money, guys. Bank is going up. We received it from a debtor, therefore we are going to credit debtor's control. How much did we receive? We received, of the amount owing, we only received 97.5%, which is 97.5 divided by 100. How did I get that 97? I took the 100% and I minus the 2.5%. It'll give us 7,020. These two, bank and debtors control, both fall under assets. So assets, bank is increasing, debtors control is decreasing. We are being owed less because default June paid us. Hence, under assets, we'll have plus minus. The plus is for bank, the minus is for debtors control. Owner's equity is not affected. It's not capital income drawings or expenses, and liabilities are also not affected. We're not owing anybody or paying anyone that we owe. We are actually being paid by someone that owed us, which is a debtor. It doesn't end there, guys. That discount that we gave the debtor's account need to be reduced by that 7,200. But you can tell here we only reduced it by 7,020. However, the reduction still needs to be 7,200. It's just that the other reduction was a discount allowed. Please note that discount allowed is an expense. We debit an expense called discount allowed because we are allowing a debtor a discount, a settlement discount. We do record a settlement discount as discount allowed. A trade discount is not recorded at all. Then we're going to credit debtor's control. Your asset there is going down. It will go down by a total amount of 7,200. And it'll go down by that 180, which will take it straight to 7,200. Assets we have minus. Owner's equity we have minus because discount allowed is an expense under owner's equity. We've got side capital income drawings and expenses. Drawings and expenses reduce owner's equity. Discount allowed here is an E, the last E, which is your expense, which will reduce your owner's equity. And liabilities will be 0. Moving right along. Last one. The May bank statement received from PNB Bank reflected the following. So we received the bank statement. So for whatever is about to come, bank is involved. It's either bank is decreasing or bank is increasing. They gave us EFT fees of 170, credit card levies of 80, and service fees of 19. All of these qualify to be bank charges. You will add them up, 170 plus 80 plus 19. Please note, if they gave you interest on favorable balance or unfavorable balance interest is an expense and it's not a bank charge. You'll have to show it separately and it's recorded in the cash payments. All of these because are payments. Bank charges are payments. They reduce your bank account. Hence, we are going to record all of that in your cash payment journal, which is also already given to us, but we will debit them as bank charges. And we debit bank charges as an expense. We credit bank because we are having less money. And we are going to record that at a sum of all those amounts, which is 170 plus 80 plus 90, which gives us 340. Bank is your asset, it's decreasing, it's credited, therefore under assets you'll have minus bank charges. Affects owner's equity because under owner's equity you've got capital, income, drawings and expenses. Bank charges are the expense, which reduces your owner's equity, and your liabilities will just be zero. Now, this is how marks will be allocated for those that always ask. But then how will this be marked? Well, it's marked this way. Okay. So if you tried it on your own, you would have probably gotten that much. And you can just put your mark over there. Okay. That's it, guys. Thank you for the support. Be on the lookout for question 2. And if you want to know where to find me, and thank you guys for the support, okay? Thank you, thank you. Throughout these 4 years, you've been supporting me, and I really appreciate it. If you would like us to have a lesson, whether online or in person, please check the description. All the details are there. Kalibito Gerifilo Di Jamela on Facebook, LinkedIn, Instagram, TikTok. Everywhere I'm Refilo Jamila. Thank you for your support yet again. Houghton.